Investors, got a pop quiz for you. How many of you heard the term 1% rule and or 10% rule, or the 1 in 10 rule when it comes to multifamily residential real estate investment? We're talking about duplexes, triplexes, quadruplexes, not apartment buildings. They have a whole other metric they use, but smaller residential multifamilies. Have you ever heard of the 1 in 10 rules when it comes to investing? So if you listen to the podcast, I'm sure you've heard them talk about it, or if you watch some of these supposed gurus, they'll mention this all the time as the path to profitability. But is it really that? What is it? For those of you who aren't listening to the podcast and who aren't watching the gurus, I'm going to explain to you what those rules are today and tell you whether or not you should be listening to them, following them, or even just outright ignoring them. My name is John Trigg. I'm the Montco Realtor, and I sell real estate here in the beautiful Philadelphia suburbs. Philadelphia, Bucks County, Berks County, and of course, Montgomery County. I am the Montco Realtor after all. So let's talk a little bit about investment today. What is the 1 in 10 rule? So the 1 in 10 rule was designed after the agreed upon purchase price of a property, not the acquisition price. Now, that would be logical. That would make sense, but no. 1 in 10 is built on the agreed upon purchase price. So for this example, let's say that you're going to buy a duplex and you're going to pay $450,000. The 1% rule stipulates that you need to be collecting gross monthly rent of at least $4,500. The 10% rule is your annualized. So that means that on an annualized basis, your gross annual rent needs to reach $45,000 or more, equivalent $450,000 purchase price, in order to meet the 10% rule. And somewhere therein lies your profitability. So is it real? And is it a good metric to follow? It is a real metric, but I wouldn't follow it. Now, that doesn't mean that it's totally wrong. Sometimes it's right, but there's a lot of factors that are left out when you start vetting properties this way based on statistical numbers. For example, it doesn't take into account what your insurance cost is going to be on that property. It doesn't take into account what are the taxes on that property. It doesn't take into account what association fees will you have, if you have any, on that property. It also doesn't take into account what are your licensing and permit fees. Every municipality is different, and you never know what that's going to be until you actually get involved in the property itself. But most importantly, even if you take all of those out and say, yo, they're not such a big deal, they are. But even if you were to ignore those, the major factor it leaves out is what are your capital improvement requirements over your first 3 years of ownership? Because those are the hardest 3 years. Those are the 3 years where you're building the rent profile up, you're building into the community, you're getting well known, you're starting to develop a reputation for your property. So what capital improvements do you have to put out for that first 3 years? And are you really just putting money out up front to try to reach this metric that you may not reach because the market can change? And if it does, what happens to your investment? So there's a lot of aspects you have to look at when it comes to vetting a property, especially multifamily, because you're taking multiple doors into account and you're dividing up the asset. When you're looking at a deal, the deal lies within all the details. That's what you should be paying attention to, all the details. Is it a community you want to have an investment in? Is it a growing community, or is it in a revision? What's happening around it? Are rents going up? Are they staying stagnant? Or are they falling a little bit? You need to think about everything and then look at the investment on a total. What's it going to cost to actually maintain this particular investment and or upgrade it in order to unlock some of that equity that you're hoping to achieve over the next few years? So the deal lies within the details. Make sure you're looking at everything, or do yourself a favor and talk to an educated realtor in the area. They can point you in the direction and help you vet out whether or not it's a good investment for you. Thanks for watching, everybody. I'm the Montco Realtor, and I'll see you guys next week.